Okay guys, we have already discussed the definition of financial instrument. We have discussed what is financial asset, what is financial liability, and then equity instrument, then offsetting, then recognition and measurement of financial liabilities. Initial recognition we have discussed that initially we measure financial liability at fair value. Then if the financial liability will be subsequently measured at fair value to profit or loss, then the transaction cost will be expense to profit or loss, right? Then we have also discussed that if the financial liability is not will not be held at fair value to profit or loss, we have to measure the financial liability at amortized cost. Then we will deduct the transaction costs deducted from its carrying amount. Okay, and what does it mean by the fair value to profit or loss? Then fair value to profit or loss means that at each balance sheet date you had to remeasure the financial liability to fair value, and if there's any change in the fair value, then you should record this in the income statement. Okay, subsequently financial liability measured at amortized cost, which is the we normally do. And if the financial liability held mean that there is some asset which you have to measure at fair value to profit and loss, initial recognition, and you take some loan. So to avoid mismatch, then you should also measure that at fair value to profit or loss. Now at amortized cost, what you will do, the amortized cost, you will have some amortized cost table, and this amortized cost you will have opening liability, finance cost, cash payment, and closing liability. This opening liability should be net proceed. Okay, what does it mean, net proceed? So it means that you have to deduct the transaction costs, and which I have already told you that if will not held at fair value to profit and loss, financial liability will not held at fair value, then transaction cost should be deducted from its carrying amount. So when you deduct the transaction cost, then you will get a net proceed, and that will be your opening liability. Okay, and you will also have effective interest rate. So you will multiply this opening liability with the effective interest rate, and you will get finance cost. Okay, and this finance cost will charge to profit or loss. So it means that it will increase your liability. So meaning a debit finance cost and credit will be the liability, right? Now when you add up these opening liability plus finance cost, and you have to pay some cash payment, and that will be the nominal value, means nominal value or coupon rate, and this cash payment will reduce your liability. So when your liability is reduced, then definitely you have to face some cash. So credit will be cash and debit will be the liability, and at the end you will have a closing liability, which will be the part of statement of changes statement of financial position. Okay, now here we have example. If you see here, this is the NOMA is issued 20,000 redeemable debenture. Okay, it's financial liability at their 100 par value, anchoring issue cost of this amount. The debenture are redeemable at 5% premium and 4 year times a carrying coupon rate of this. Okay, now this is a coupon rate, is a cash payment you have to pay. This is the effective interest rate, which increase your finance cost. Now calculate the amount to be shown in statement of financial position and a statement of profit or loss for the 4 year of debenture. So this is very simple. You have just to deduct the normal we will deduct this. We will use amortized cost. Subsequently we will measure this amortized cost. So what you will do, you will do this anchoring cost, you should deduct. Okay, and you will write here, here's a table, opening liability, finance cost, and this is the cash payment and closing liability. This net proceed will be like this, 20,000 and multiplied with 100 as a for value, and you have to deduct this 100 you will deduct this amount and you will get 1900. okay, we'll just remove this 300 for simplicity and we will get here, this is the net proceed. Now what is the effective interest rate? Effective interest rate is already given, this is 4.58%. so you will multiply this and this will increase your liability, so this amount will be added with this amount, okay, and this will increase your liability, so you'll debit finance cost and credit liability. And now cash payment, so the cash payment should be on nominal value, and the nominal value we have 20,000 multiplied by 100, this is the nominal value, and you'll use this coupon rate, which is where is the coupon rate here, here's the 2% your coupon rate, and you will get this amount. So this is the cash payment which you have to pay, and this will deduct because this will reduce your liability, and at the end you will have this amount. Doing the same practice, and at the end you have to pay the premium of 100, and you will also pay the actual amount, which is 20,000. Here you see this is the actual amount you have to pay, this will be paid, okay, but you also pay some premium, and the premium is 5%. so if you take 5% of this, that will become 100, and you will 2000 plus this will become 2021, mean 2100. okay, so this at the end you have to pay the whole amount, and at the end you will have zero liability. Now we have another question, and this question is loan issue at a discount. So mean loan issue at discount, there's some discount at the loan issue. Now on 1st Jan, okay, first you see what the requirement is. How will this be reported in financial statement of James for the period of the future redemption? So mean how you record this or the period to redemption and the statement financial position. So if you see here on the 1st Jan 2001, James issued loan note of this amount 50,000 with the nominal value. Now it was issued at a discount, so mean you have issued at discount, so you will deduct this discount from this amount, will become that will be your net proceed. And you have to there are some cost of issue, so you also deduct this 2,000 from, and interest of 5% of the nominal value. So I mean this is the coupon rate. The annual, okay, the bond must be redeemed on the 1st Jan 2006 after 5 years. So if after 5 years you have to redeem it. Now the premium you will pay is this amount. So this is the premium amount you will pay. Mean this amount 50,000 plus this 4611. Okay, you have to pay. The effective interest rate is given as 12. Okay, now using the same format, we will measure initially we measure at fair value, and subsequently we measure at amortized cost. So at opening liability at amortized cost will be the net proceed. What does it mean? It means that the face value we have 50,000. Now there is some discount, we issue a discount, so the 15% of this amount will be, you will get this amount, and after deducting the issue cost of 20,000 you will have this net proceed. So the net proceed will be here. Clear? Now applying the effective this is the opening liability in the net proceed, and you have to use the effective interest rate like this 12%, and this will give this amount. So this will increase your liability. So debit will be liability and credit will be definitely you have to pay some debit will be finance cost and credit will be liability. Okay, because this will increase your liability and also increase your expenses. Now if you see here, we have to deduct this amount, and this 5% you should apply on the nominal value, and the nominal value is 50,000. So 50,000 when you multiply with this coupon rate, then you will get this amount, you will deduct this amount, and at the end you will have this amount, right? Now at the end of 5 years you will pay 50,000, okay, plus some premium, and that is also you will get this amount. Now at the end you will have zero liability. Okay, this amount, which is the finance cost, if you add up these amount, you see here if you add up all these, wait a minute, okay, if you add up these, then you will get this amount, fine. And if you add up these, then you will get this amount, and this amount will go to the statement of change equity because it is a part of, and this is a cash, so it is part of equity, and this will be finance cost in a statement financial position at the period year. Okay, fine. Now calculation of effective interest rate. So if there is no, if effective interest is not given there, and then how you will calculate. So you will calculate like this: redeemable value of the bond divided by purchase value of the bond, then you will get a value, and this value you will check in the discount factor tables. Let's say the value come like 1.100. You will check this, so this will be 10 will be your discount. Let's say it come like 1108, so this will be like this, and this is the techniques that you have to calculate. Let me show you how. You see here, this G company purchases a bond. Okay, this is purchase a bond, so it's a financial asset. You purchase a bond, okay, and we have already discussed this at the time of financial instrument, when you are the lender. So definitely you purchase a bond, so you're the lender of the money, and you will have financial asset. This is a financial asset on 1st Jan 2001, and it will be redeemed at 31st December 2004 at this amount. Now we have purchase value is this one, and the redemption value is this one. The bond will be held at amortized cost and carry no coupon. So there is no coupon rate. So it is no interest rate. There is no effective interest rate. So how you will do is redeem value. Redeem value here is 6,000. So 600. You see here this 600. This amount will be like this. You will see here 600 divided by 4441014, and then you will get some of values, and this will you check in this discount factor. So that will be your effective interest rate. Let's see here. If you see here, we will have this amount after using that working like this redeem value, and then if you see here, I will show you redeem value of the bond as and then divided by purchase value. So the redeem value is 6,600. Let's say just say 600, and then the other value you will use here. Let me show you here. You see here, this is the redeem value is 600, and like this 600. Let me try to complete, and this 41011. So you will get a value, and that will be Ifrs in the discount tab. So I will write here, and you see here is finance. This is not a financial liability, it's a financial asset. So it will be finance income for us. And if you multiply this 8% with that amount, purchase the land amount, then you will get this finance income. This will be your interest income. Now if you see here at the statement financial position, your non-current asset, you see financial asset, this is your non-current asset plus this amount, and you will have this amount. So mean at the time of financial liability, we opening liability plus finance cost increase your liability, and here your financial asset is increased 4410144 plus that interest, interest or finance income will increase to 81, increase your financial asset. Now come to this point. Here is we have some transaction, like let's say this is a company, and this is a person is raised finance on 1st Jan 2001, okay, and issue of a 2-year bond, 2-year 2%. This is a bond coupon rate bond with the nominal value is this 10,000, and it was issued at a discount of 5% and is redeemable at a premium. So this is just an issue cost. You have to ignore the bond effective interest is this amount. So how you will treat this transaction on 1st Jan 2001, H raised finance, okay, and issue 2-year a 2% bond with a nominal value of this amount, and there's some issue cost of 5%, and there's redemption at the time of redemption you have to pay some premium, and that is this amount. Okay, then how you will treat, let me show you. So this is financial liability. Okay, this is financial liability because you have raised the finance by issue of bond, and you know initially the financial liability is measured at fair value. Fine. And if the financial liability, if the financial will not be held at fair value to profit and loss, meaning if you had to measure this as subsequently measure at amortized cost, then you will deduct the remaining cost, issue cost, transaction cost. So H has financial liability to measure at amortized cost, and financial liability is normally measured at amortized cost. Now financial liability is initially recorded at fair value, and the consideration received, means whatever amount you have received you have to record. Now this consideration should be the net proceed. Net proceed means that you have to deduct the transaction cost and some issue cost, whatever the cost is, you have just provide the net proceed is opening liability. Now this amount is then increased each year, and this amount, definitely this amount is increased each year because of the effective interest rate, and that will increase your finance cost as well as debit will be finance cost because expense will increase, and credit will be liability because liability also. Now this amount is also reduced by the actual cash repayment. So you have to pay some amount like using a coupon rate, then you will have a reduction in the liability. Okay, fine. If you see here, this is the net proceed, and how you will get this net proceed. If you see, and the question said that is the nominal with 10%, and this 5% discount. So 10,000 5% you will get 500, and we have already studied this that we have to deduct this the 500 which is issue cost, and we will use the net proceed value below and the opening liability. Okay, here so you get this is opening liability, and this is opening liability net proceed, and you have to multiply this with the opening liability with effective interest rate, and this effective interest rate will increase your finance cost, debit will be finance cost, and credit will be liability because also increase liability. Now the coupon rate is the actual payment which you have made, so this will be 200 because the coupon rate the nominal value is 10,000 because we have to use the actual value, the nominal value, and that will be 2%, so you will get 200. And after adding 9500 add with 950, then after deducting this 200 you will get this amount. Now in the second year repeat the same process, but at the year 2 there is some other thing you have to add up, and the other thing is you have to redeem the thing by using a premium. You have to pay premium, and that is 175. Oh no, this is not 175. Let me check it how much the premium is, and the premium and the question okay here, and this amount is the premium. So mean at the end you will pay 10,000 plus this amount. Okay, and this is the actual amount, and at the end you will have no closing liability. So this is the 1105 is the nominal value plus premium, and at the end, if you see here, there's no liability. Now here we have another we have some another transaction, and another transaction is raised finance by the issue. Okay, and we have already discussed these all things in the previous video, so okay, if you go there and check then it will be good. Okay, now we have just start amortized cost we have already discussed. Okay, and out of money I have already discussed this thing also. Okay, now we will discuss this fair value model because in the previous there's some technical problems. And okay, now here if you see we have discussed two things. The first thing, initially we measure at fair value. Now after initial, subsequently we measure at fair value, profitable loss, or amortized cost. Okay, and amortized cost we have already discussed and a very detailed, and now we will discuss fair value. So out of money derivative, I have already discussed this thing also, that the derivative is not attractive, not compatible, and liability which are held for trading. So liability when held for trading, then you should measure at fair value profit loss. Clear? This is the first thing you have to remember. The second thing is when you will measure liability at fair value, when the liability is when that liability is normally measured at amortized cost. So in this case you will so if there is some if you have to eliminate or to reduce accounting mismatch, then you will measure liability at fair value to profit or loss. For example, if the amount received from loan, so let's say you have to receive some loan, okay, fine. Now to invest in asset, in this loan you have to invest in asset, mean you have taken this loan and you have to invest this in asset, and this asset is recorded at fair value. So normally this loan is measured at amortized cost and this asset is measured at fair value. So this is accounting mismatch. So if you want to reduce this mismatch, mean the mismatch of the asset recognition and the liability loan recognition, then the standard also allow you that you should use fair value through profit or loss instead of amortized cost. Okay, I first say that any moment in fair value is split. Okay, so if there is any moment, means there's any changes in the fair value, so the fair value is split into two components. The first component is if the fair value change due to your own credit risk, then that amount will goes to the other comprehensive income. Okay, means that the risk that the entity which has issued the financial liability will be unable to repay or discharge it, which presented a OCI. So you should if there is a fair value change is due to your own credit risk, then you definitely you will charge that to the OCI, other comprehensive income. Now if the fair value change due to market interest rate, then this will goes to the profit or loss statement. Clear? So mean the IFRS 9 say that the fair value changes as split the moment in fair value is split into two components. If the risk is due to own credit risk, then you will charge it to the profit or other comprehensive income. If it's due to market interest rate, then you will charge that amount to the profit or loss. Now how you will calculate the fair value if there is no fair value of financial liability? The technique is very simple. By computing the present value of the future cash flow, so for present value of future cash flow using the sum of two rates. The first one is market interest rate and the second one is credit on entity on credit worthiness. The fair value, there's a table, you have to use this table. You write here the date, here will be the cash flow, and there will be discount rate, and here we will have present value. The total of the present value will be the fair value of the financial liability. Clear? And for this you have to use this rate. Now here we have example. If you see on first, okay, discuss the accounting treatment of the liability on 31st December 2001. Now on 1st Jan 2001, M issued a financial liability for its nominal value of this amount. This is the nominal value. Okay, on 1st Jan, M issued financial liability, nominal value is 10 million. Interest payable at the rate of 5%. This is interest payment, and this interest in area. Now the liability is repayable, so you have to pay this liability at 31st December 2003. Okay, now M traded the financial liability in a short term. So when the financial liability is tradable, is traded in a short term, then you should measure at fair value to profit or loss. The second, if there is some what we have studied here, or out of money derivative, then you should also measure at fair value to profit or loss. So how you will treat this thing, and okay, now the market interest rate has risen, this interest rate has increased by 10%, and this is the due to the fair value change will be due to the market interest rate, so you will regard this into the profit or loss statement. Okay, Now how you will treat this and how you will discuss. So financial liability is traded. I told you before the financial liability is traded and the short term. So as financial liability is traded financial, then we will measure at fair value through profit or loss. Means subsequently we measure at fair value to profit or loss. The first thing. The second thing, liability must be remeasured, because the financial liability will be remeasured to fair value at the reporting years. Because what does it mean that fair value to profit or loss means that the financial liability will be remeasured at a balance sheet date, and if this in change that you will record. Okay, now let first we have to measure the fair value of financial liability on at the balance sheet date 31st December 2002. Here will be have a cash flow of interest 5%. Okay, you just apply the 5% on the nominal value, which is 10 million, and here's a discount rate, and discount rate is 10%. If you see here with the discount rate is here. The market of interest rate has increased to 10 million. So this is your interest rate, because interest rate increased to 10%. And this will be the discount rate for you, and this will you also do from the discount factor table. Okay, after multiplying these things, then you will get this amount, and at the end you have cash flow of 10 nominal value plus this cash flow, and you will have this amount, and after multiplying with this, then you will have this. Okay, fair value of liability at the end will be 9.13, which was 10 million before. Now the fair value of liability at the 31st December at year end will be 9.5. So the following adjustment you have to do. The first one is the liability will be decreased. You know, debit liability means that decrease in liability with this amount, and this change is due to market interest rate. So we will record this into the profit or loss. So this will be the income for you guys. So because fair value change is due to market interest rate. Okay, now come to another question. Question number being regularly invest an asset. So this being as regularly invest that are measured at fair value to profit or loss. So being invest an asset, and that asset is normally measured at fair value to profit or loss. Okay, so being regularly invest an asset means and that asset is measured at fair value to profit or loss. Oh, this is clear now. Okay, here now the asset these asset purchases are funded by issuing a bond. So that asset which are measured at fair value to profit or loss are funded by using issued bonds. So means that loans you have to, and if the bond were not remeasured to fair value, the accounting mismatch would arise. Means that this loan, this bond loan, this is bond or loan, whatever it is, you are using for asset, and this it is measured at fair value. So if this loan is not measured at fair value to profit or loss, then there will be mismatch. Okay, now the fair value of the bond fell by 30 million. So the value of the bond is, and the fair value of the bonds goes down like 30 million during the reporting period, and of which 10 million related to being credit for. Okay, now of this amount 30 amount, the 10 million because of the credit worthiness, right? And the remaining definitely will be due to market interest rate. So we have already discussed that because of the credit worthiness will goes to OCI, and interest rate will goes to, because of the market interest rate, then it will goes to the profit or loss. So how should the bond will be accounted for? And as we sample, when the financial liability is designated to be measured at fair value through profit or loss, to reduce the accounting mismatch, the fair value must be split. So we will split the fair value measurement. Okay, fair value moment, and due to own credit risk, that will goes to the OCI, and the remaining means the market interest due to market interest, it will goes to profit or loss. So the being liability will be reduced by this amount, because you know the bond value, the bonds value fell down by 30, and this of this 30 amount, the credit of 30 million, this million due to credit worthiness will goes to OCI, and the remaining 20 will record in profit or loss. So you will just pass this entry. You see the liability is a whole liability is decreased by 30 million, so we will debit it, and OCI, due to OCI it will be will goes to the OCI, as due to credit furnace it will goes to OCI, and the remaining will goes to the profit or loss. Okay, here we have another example. In example, Johnson, an investment property company, adopted a fair value model to measure its investment property, and the fair value of the investment property is highly dependent on interest rate. Johnson investment property company, so it's an investment property company, and adopted a fair value model to measure the investment property. So mean that Johnson using fair value model for measuring that asset, that is a property, investment property. Now the fair value of investment property is highly dependent on interest rate. Fine. The finance director of Johnson has requested your advice on accounting for the following financial instrument transaction which took place and the year ended 31st December 2001. If you see here, on the 31st December 2001, Johnson took out. So Johnson took out this amount from the bank, and this bank amount is specifically to finance the purchase of some new investment property, and we know that investment property is measured at fair value to profit and loss, and this amount loan is also taken from the bank specifically to finance this. So this loan is normally subsequently measured at amortized cost, but standard also allow us that to avoid accounting mismatch, then you should also measure this amount with fair value for now. The fixed interest rate at the rate is 5% is charged for 10 years terms. Okay, it's fine, and the transaction cost is this amount. Okay, now that one thing is clear. The first thing is what? The first thing is this amount will now be expensed to profit or loss, because the financial liability, which is the 9 million, I will just write 9. Okay, fine, I will write this financial liability will be held at fair value to profit or loss. So when the financial liability subsequently held at fair value to profit or loss, then the transaction cost will be expensed to profit or loss. Fine. Okay, this is done. Now this loan is also measured at fair value to profit or loss. Now discuss with a suitable calculation how the above financial instrument should be accounted for in the financial statement of Johnson for the year 31st. Now at initial recognition, we know that financial liability means that bank loan will be measured at fair value to profit and loss. Okay, now it will not be held at fair value, okay, and will not be held at fair value to profit or loss. Means if the financial liability like this loan will not be held at fair value, so we mean that this means that we normally must subsequently we measure at amortized cost. Okay, and if we measure this at amortized cost, then transaction cost will be deducted from its carrying amount. I mean this amount, okay, less this amount, then we will have some amount, and that will be the net proceed, which will be using the amortized table. But in case of Johnson, okay, this is the normal treatment. Now in case of Johnson, initially we measure initial measurement of fair value less transaction cost on 2001. So this is the normal measurement. Okay, and here's the calculation, that 9 million less this amount, and this is financial liability. But now we have to just avoid the accounting mismatch. Subsequently, the amortized cost using effective interest rate measure finance cost recognized for plus. This is the normal treatment. How is possible to measure financial? Okay, now this is the point. From here we have started a find, and that is that the financial liability which mean the loan, the bank loan which taken for the asset, and that asset is measured at fair value to profit and loss. So the liability can also be measured at fair value to profit and loss according to Ifrs 9. When it will normally be measured at amortized. So normally this normal treatment I have done here, you see here, this is the normal treatment of bank loan. Okay, but here we have a case, and the case is that we have to just eliminate or reduce. The first thing you have to eliminate. If you cannot eliminate, then you can reduce accounting mismatch. This option is available to Johnson here because the bank loan is being used specifically to finance the purchase of investment property, and we know that Johnson accounting policy is that investment property is measured at fair value to profit or loss, and with the gain or loss recognized as profit or loss. Fine. So we can also measure the bank loan. So if the bank loan were measured at amortized cost, and there should be measurement, mean that if you measure the loan at amortized cost and investment property or the asset which for which the loan have been taken is measured at fair value, so there will be accounting mismatch. So we have to just eliminate this thing, and for that we have to choose initial recognition, the fair value this amount, okay, and transaction of this amount will be explained to profit or loss, and subsequently we will measure the loan at fair value to profit or loss, and any gain or loss being recognized in profit or loss. So the thing is very clear. Mean if you have taken some loan, and this loan is for what? This is for asset, and this asset which is measured at fair value, the loan should also be measured at fair value. Okay, in the next lecture inshallah we will discuss the compound instrument, okay, and some other things.